This is a chart of the userx, the largest gold-based mutual fund in the US, and what I want to highlight on the chart are a couple of things. This goes back all the way to 1976, by the way, which is why it's a little bit difficult to see all the data. So that 86, 96, this is like 22 years of data. What I want to highlight is we have something very unique that's happening. If you've been following the other videos, you know I talk a lot about the userx and the death run highs that you sell and the life run lows that you buy. We have something that may happen in the next couple of days which is quite unique, and some people may not have come across the concept, where there's actually a double life run low. One is a major, one is a minor. And what I want to highlight here to show you the usefulness of the pattern, this is 1976, where they had the first great life run low, and that was in the $10–11 range. userx ran up at the parabolic peak to about 105. Well, in 1976 you had the major life run low, but then there was a second minor life run low in 1978, just before everything went crazy. And I've got quite a few charts I'm going to try and put here in this 10-minute segment to get that point across. We've had another life run low, major, in September of 2008, and we're just 2 days away from forming a minor second life run low a month later in the month of October 2008. Now, what's the difference between major and minor? It's the number of days decline to form the buy. And if you don't understand the concept, if you're watching this video, go to YouTube MJR Stocks and watch, I think it's starting around video number 65 or 66. There's maybe 4 or 5 videos on the userx that explains that in detail. So to clarify the point, major is more than 5 days and more than 2% per day average decline. So if there was a major one, let's say it happens to be 8 or 9 days, where a minor life run low would be a 2 up pattern and 5 down, averaging maybe 2%, but not 2.5 and not 7 or 8 days. So it's like confirming perhaps the original life run low pattern. But take a look at how cool this is. From the $11 range up to 105, there was a death run high that you sell, and a death run high for a 10-second analysis is where you get a 2 down and 5 or more days averaging more than 2% average per day up. You got another life run low right here. So basically you made almost 1,000% in that parabolic rise. And then from here in the $30–31 range on the userx in 1982, you had, and remember again, you know, 1980, 1982, there's generally a 2-year time frame from a death run high to a life run low. You made another 300% where it formed like a double top, and it also formed this long declining angle you can see here. By the way, this is my shoelace, because you cannot draw trend lines on a 30-year chart. There's just not enough programs. I haven't found one that can actually do that. I'm sure there is, but I just haven't come across it yet. So if you see some idiot walking down the street with one shoelace, you'd probably say hi to me. This is quite unique. This trend line goes all the way back from 1980. This is getting to the point where it's a 28-year trend line. Now that is just mathematical symmetry, like poetry in motion. And this is where we peaked out in 1980. The trend line resistance in 2006 and 7 happened to be in the $18 to $20 range on the userx, which is pretty much exactly where it got to. And just a final point on this chart. So we had the life run low here, the death run high. We had the minor life run, so that's a pattern of 2 life runs a low, 1 major, 1 minor to confirm. Sell, life run low buy here, death run high here and here, and then from that point there were a couple of minor patterns that took place in terms of buy signals, but they did not provide any fabulous yields, because in effect you can see from the chart we were in a 20-year bear market in commodities. Now the last point is in 1998, when we had the last major, up until September 2008. So in 1998 there was a major life run low. The userx ran up and then actually ended up declining below that initial life run low. Didn't execute a second life run low, but that was the pattern. So if you just followed the discipline, then and held, it actually went from around 231 all the way up to 20. I think 1796 was the 1797 was the death run high in May of 2006, and we've just recently had the major buy at the 1106 or 1109 range, and we're now in the, I guess it's about 865, something like that on the userx, and it looks like it's going to form a second minor life run low over the next few days. This is now October 2008. Here's a quick little review just for 30 seconds. This is the gold chart going initially from 1971 to 1976. And you can see it ran from 35 up to around the $180 or $200 range, and then it went into a big time correction, which is exactly what we're doing right now, just completing that. I would expect over the next few days. Doesn't mean that we may not have a secondary decline in the summer of next year, but we'll have to see how that plays out. Now once that correction completed itself in 1976, you can see what happened. So remember, 71, 35 to around the $200 range, corrected back to 100, and then gold went up 850% over 1, 2, 3 years. And this is pretty much where we are in the cycle now. We're just getting ready to absolutely rocket into the outer atmosphere. And if gold does this, you can just imagine what the gold stocks are going to do, because they are highly leveraged to the price of gold. Very quickly, here's a long-term gold channel going back to 1968, and you can see that the run-up, there's the correction in the mid-70s, and then it just skyrocketed up to 1980, and then it went into that 20-year bear market, and we bottomed here in 2000, 2001. We've actually reached over the $1,000 level up to, I think, 1,033. We've now completed this kind of a mid-cycle correction, and gold now is trading at about 800, so you can just see how the chart is kind of heading up into the outer atmosphere. Here's a quick chart just to highlight 2 points. Number one, it goes back to 1971. This is 37-year gold. We're actually now in the October 2008. There's a thing called fan lines, and when you can see a parabolic rise, and that shows the 850 level, even though it didn't close at that level, that was the intraday. Here's the first line if you follow the mouse. Here would be the second, and here would be the third. When a stock or an index or a commodity breaks out of a third fan line, that tends to be a major breakout. And once it'll break out, it may come back and test it, and then it'll just skyrocket, and you can see in fact what's actually happened to this chart. They're just showing one trend line here, but in fact you can draw one, you can draw two, and then here would be the third. Pretty much going to end up at the same price level on the breakout, and then it's just been a mega bull market since that time, starting in 2000, 2001. I think gold bottomed at around $252. I found this graphic online, so I thought I would just make a quick little chart to highlight it. A really neat quote that I came across was that when the person with money meets the person with experience, the one with money gets experience, and the one with experience gets the money. Remember that one. This guy goes to his broker, and he's trying to understand the term bull market and bear market, and he can't figure it out because he's a new investor. And so his broker says, well, a bull market is when stocks are going up, and a bear market is when stocks are going down. And the client said, well, in a bull market, how high will prices go? And the broker said, well, it depends whose bull you're listening to.